What's going on with HIMS stock? Year to date, the stock is down tremendously, right? The stock is up 110%. But in the last couple of days, we've seen the stock go up 10%, go down 10%. Why? Because of GLP-1. Even though right now, this makes up a fraction of the revenue that the company generates, right? And yet, every time we hear GLP-1, shortage, no shortage anymore, lawsuits, no lawsuits, this moves the stock. So let's discuss all of that in this video. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not. We'll really appreciate that. If you want to support me even further, do check out the links down in the description and in the pinned comments with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. Now, HIMS right now is a company with a market cap of $4 billion and a forward PE of 28.2 times, EV to sales in the next 12 months, 2.2 times. So definitely not the most expensive stock out there. If you look at what the analysts are expecting for the next coming fiscal years, including fiscal 2024, this is a fast-growing company, top and bottom lines. Now, right now, if you look at the average analyst price target, sits 17% higher than the price we're at today. Looking at some pricing metrics here, forward PE, EV to EBITDA, price to sales, price to free cash flow, we can see that we are below the 3-year mean or 2-year mean, depending on which one you're looking at. We are below the forward PE, EV to EBITDA, price to sales, and price to free cash flow. That's in the last 12 months, sits at 40.2 times. Now, all that said, I do want to start by going back to the earnings call and hear what management was saying. So in the second quarter, we were able to drive north of $300 million of revenue from our suite of offerings outside of GLP-1s. So fully consolidated revenue in the second quarter grew 52% year over year to $315.6 million, representing a 6-point acceleration in year over year growth relative to the prior quarter. They then go and talk a little bit about GLP-1s, in this case, personalization. So personalization for GLP-1 solutions will be supported by two fundamental components. The first is the breadth of products offered on the platform. Recently, we launched personalized dosage for compounded semaglutide. Apologies for mispronouncing a lot of these names right here. I'm already warning you in advance, but these names right here are quite important for the discussion. The providers can prescribe in response to side effects concerned and desired levels of weight loss. Patient feedback to their provider during the titration process can inform the appropriate end state dose for users. Additionally, we're excited to expand the scope of offerings available on the platform, and we'll look to add tirzepatide or something like that and liraglutide to the existing compounded semaglutide offering in the near future. We expect this portfolio of solutions will be inclusive of branded offerings when supply allows. Now, when the FDA announced that, declared that the shortage of Lilly's drugs have been resolved, that's when HIMS dropped around 10%. Why is that? Well, because in the list of GLP products, you can see here the shortage status. The first one here, which is Lilly's product, shortage resolved. Okay, stock went down. But the one that they are offering, that HIMS is offering, is Novo's one, which is this one right here. And this one is still in shortage. Now, why is the stock down then? Well, first of all, because they expect to offer multiple types in the future. And second of all, maybe soon enough, this one right here, semaglutide, might also have their shortage resolved, which could hurt HIMS. Now, how does that affect a company like HIMS? Well, it says here, this is not me saying, this is the FDA. The FDA does not permit the compounding of a product that is essentially a copy of an approved product unless it appears on the drug shortage list. Under the current FDA guidance for 503B pharmacies, they are no longer permitted to accept new orders for tirzepatide, again, apologies for mispronouncing this, that are essentially copies of the Lilly product. They are permitted to dispense orders that were received before the shortage resolved for the next 60 days, and that's about it. Now, on the flip side, why did we see the stock rebound yesterday or 2 days ago at the time of we watching this? Is because of this. Compounding Group sues FDA for removing Lilly's weight loss drug from shortage list. They say that, of course, Lily would say this so they can monopolize the market and make more money, etc., etc. To be honest, I don't know what will happen, but as of now, it does not hurt HIMS that much. Might hurt them in the future if there is no shortage at all in any of those products right here. Now, going back to what has happened last quarter, we can see revenue increased 52% year over year. Net income was $13.3 million. Adjusted EBITDA increased 270% year over year. Operating cash flow increased 219% year over year. And free cash flow increased 377%. Now, as for Q3 and fiscal 2024, they expect revenue growth of between 65 to 68% for Q3 and 57 to 61% year-over-year growth for the fiscal 2024. As for adjusted EBITDA, they expect a margin of 9 to 11% for Q3 and 10 to 11% for fiscal 2024. As you can see right here, total revenue has of course exploded in the last couple of years, and free cash flow is improving quite nicely. It's important to look at free cash flow here because we're going to do a reverse DCF real soon. Then, looking at some other metrics for the company, average order value has increased throughout the last couple of years as well. Total change 63.5%. Net orders have increased by 161% since September 2021. As for gross profit since 2018, the compound annual growth rate was 135.9%, and operating income is now turning positive and expected to grow quite quickly in the next coming fiscal years. Now, to look at the expectations for the current year, the next quarter, and the next year for EPS and the growth rates, we can of course go to Yahoo Finance, or we can go to other websites and look at what's expected in the next coming fiscal years. Look at how many analysts are modeling for that as well. Of course, the further you go out, the fewer analysts. So you have to take that into consideration when looking at the numbers in 2032, 2031, and stuff like that. So the average year-over-year growth rate sits at 14.4% for EPS. And as for revenue, that sits closer to 19.5%. Although there is a huge increase in 2032 to 2033. I mean, it's expected to grow close to 60%. So you go from $6.87 billion to $10.92 billion. So yeah, that's quite a huge difference. And so right now, if we put here HIMS, the free cash flow trailing 12 months, which is close to $101 million, the terminal growth rate and the discount rate, we can see that the implied growth rate to justify today's price is 9% for the next 10 years, which seems quite okay, right? We've just seen that it's expected to grow faster than that. Now, if we go and look at the pricing metrics, so forward PE and price to sales here, right now, as we've seen, forward PE 28.3 times, price to sales in the next 12 months, 2.2 times. So if we go and look at the numbers that we've seen, so EPS in 2033, that's expected to be $1.36. If we then look at forward PE, we put here 28, just like we're at today, that would represent 104% upside from the stock price we're at today. If we put it even higher at 33, it's 140%. If we do it lower at 20, that's 45% upside. If we go even lower than that, 15, that's just 9% upside from the price we're at today. Doing the same here with revenue, although scenario number one is looking at revenue before we saw that huge increase close to 60%, so that's $6.91 billion. And here, there's a bit less of upside, right? If we look at this scenario right here, 2.2 times is what we have today. So that would represent, 19% downside. 3x would represent 11% upside, and 4 would represent 47% upside. Now, if we change it up and we do put the $10.9 billion, of course, the story changes a little bit, right? The 2.2, same as today, would represent 28% upside from the price we're at today. If we put an even higher premium, 3 or 4, that's between 74 to 133% higher than the price we're at today. Now, going back to the reverse DCF, this is free cash flow trailing 12 months. We've seen that it's expected to grow quite quicker in the next couple of years. Free cash flow. We've also seen that revenue is expected to grow faster than 9%, EPS as well. So let's say we increase that to 14%. If we increase that to 14%, this would mean that the estimated intrinsic value sits close to 50% higher than the price we're at today. If you think 14% is too much, then we'll go a bit lower in between the 9 to 14, 12% here. That still implies 27.4% upside from the price we're at today. And so right now, looking at the chart, this might be one of the biggest cup and handle patterns I've seen in a long time. I mean, if you start all the way back here, February 2021, you draw a cup and then a handle. Usually what happens is you go up and to the right. So maybe, I mean, this is not Picasso style, but could this happen? Could very well be. We've seen here a quick recovery from when the stock went under the 200-day moving average. We also now made our way over the 50 and the 20-day one as well. RSI has some momentum, not nearly overbought. So let's see what happens in the coming weeks. Of course, there's earnings season starting. That's going to be quite interesting, hearing management's commentary on everything that's going on with GLP-1, the shortages, how that will affect HIMS in the coming quarters and years ahead. So overall, that's about it. That's what's going on with HIMS. Do share your thoughts down in the comment section below. Like, subscribe to all of that, and I'll see you all in the next one. Bye-bye.